Polls.
Thank you for having me.
Yeah. And we thank you for being here, Barnaby.
Okay, picture this. You just signed the closing papers on a major asset, maybe that mobile home park you spent, what, a decade building up?
Yeah, the big moment.
Exactly. The sale price is fantastic. You've created massive equity. And just for a second, you feel, truly free.
That euphoria.
Yeah, it's real.
But then reality hits.
Yep.
That sale triggers 3 major tax consequences. People sometimes call it the tax trifecta.
Mm-hmm.
And suddenly, that huge sale price, it doesn't look quite so large once the IRS and the state come calling for their cut.
Mm-hmm.
It immediately shrinks your reinvestable capital.
Right.
So today, we're doing a deep dive into the specific strategies. We're talking installment sales and 1031 exchanges that successful MHP sellers use to legally defer and minimize those tax hits.
Yeah, the goal is keeping more of what you actually earn.
Our mission is exactly that, making sure you keep more of your hard-earned money. No confusing tax code riddles, just real numbers and solid strategies.
It's true. Look, every seller, it doesn't matter the asset class really, faces these 3 invisible hands reaching into their equity pocket. Okay, lay them out for us.
Well, first is the basic one, capital gains tax. That's the tax on the profit.
Right.
Sale price minus your adjusted cost.
Got it.
Second, and this one often catches people off guard, is depreciation recapture. Basically, the IRS wants back some of the benefit from the deductions you took over the years.
Ah, the sneaky one.
You can feel that way. And third, you can't forget the state. State taxes, they want their slice of the pie too.
So let's try and put a number on this pain. Say you bought a park for $500,000, you worked it, improved it, and now you sell it for $1 million. That looks like a $500,000 gain on paper.
Sounds great.
But what percentage of that $500,000 actually vanishes because of this tax trifecta?
Conservatively, you could easily lose, say, 25 to 30% of that profit just to these combined taxes.
Wow.
So on that $500K profit, that's potentially $125,000, maybe even $150,000 gone before you even get a chance to think about reinvesting.
Ouch.
Yeah, we've definitely seen clients who didn't run this math beforehand. They call up a week after closing, realizing they just lost the cost of a pretty nice car instantly to taxes. That's exactly the pain we're trying to help you avoid.
And it's interesting, isn't it? The key insight here seems to be that the government doesn't necessarily want you done investing. They almost prefer your money stays in motion, working in the economy.
That's a good way to put it. They incentivize keeping capital deployed rather than just sitting there after being taxed.
Okay, hang on. Before we jump straight into the solutions, let's make absolutely sure we understand the core of that tax calculation, because that adjusted basis thing, it can be confusing. How do we figure out the actual profit amount that gets taxed?
Right, good point. You have to calculate your adjusted basis. Think of it as the official cost the IRS recognizes you have in the property today.
Okay.
The simplest way to think about the formula is start with your original purchase price. You add any documented capital improvements you've made. Think major stuff, not just paint.
Like roads, utilities.
Exactly. And then you subtract every dollar of depreciation you've claimed over the years.
Okay, let's use our numbers again. Bought for $500,000, spent, say, $100,000 on those big improvements. New road, electrical pedestals. So that gets us up to $600,000.
Right.
But then, over the years, we took $80,000 in depreciation deductions to lower our taxable income.
Okay, so you take that $600,000, subtract the $80,000 depreciation.
Right.
Your resulting adjusted basis is actually $520,000.
Ah, I see.
So when you sell for $1 million, your taxable capital gain isn't the full $500,000 difference. It's $1 million minus $520,000, which is $480,000.
Okay, $480K gain. Now, how does the tax break down on that?
Okay, let's look at that $480,000 gain.
Right.
If we just assume, a combined federal and state capital gains rate of maybe 25%, could be higher, could be lower, depends.
Sure, ballpark.
Ballpark 25%, you're immediately looking at writing a check for $120,000.
Wow, okay.
But, it's just the start. Remember the recapture kicker?
Right, the $80,000 of depreciation we took. Why is that taxed differently? You mentioned maybe a higher rate, up to 25%.
Yeah, the nuance here is, it's crucial. That depreciation you took each year. It reduced your ordinary income from the park back then.
Okay.
So since it offset ordinary income, the IRS taxes it back, essentially, at ordinary income rates when you sell, but it's capped at 25% for this type of recapture.
So it's not treated like the long-term capital gain.
Exactly.
Right.
That's why the recapture tax exists. It's designed to treat those past tax savings differently.
Got it.
So You take up to 25% of that $80,000 depreciation you took. That adds another $20,000 loss to the tax man.
So the 120K just became 140K.
Yep. Now, your original $480,000 profit is instantly shrunk by $140,000. And that is why planning ahead is, well, it's not optional if you want to maximize your outcome.
That really drives the point home. A harsh lesson if you don't plan. Okay, let's pivot hard to the solutions then.
Yeah.
If you want to avoid that massive tax hit all in year one, what's the first major deferral strategy? You mentioned becoming the bank.
All right, the installment sale, sometimes called seller carry or seller financing. It lets you, the seller, spread out the recognition of that gain over the term of the loan you provide to the buyer.
So instead of reporting the whole $480,000 profit right away,
You only report the gain piece by piece as the principal payments actually come in over the next, say, 5, 7, maybe 10 years.
okay, so the seller finances part of the deal for the buyer. The buyer pays you principal and interest monthly, or maybe interest only for a period. The benefits sound pretty good. Spread out the taxes, plus you earn interest on the money you've essentially already made.
It's definitely an excellent way to create or maintain cash flow. But, since you're stepping into the lender's shoes,
There's always a catch.
well, it raises a really important question. What happens if that buyer defaults in, say, year 3?
Yeah. That sounds like a pretty significant risk. If I'm carrying the note, I'm basically on the hook for that buyer's performance, aren't I?
Exactly. You effectively become the collection agency. While an installment sale offers flexibility, your biggest risk is definitely credit risk, the buyer not paying.
And if they default?
Well, you typically have the right to take the property back, foreclose, but that can be messy, expensive, time-consuming, and you've only deferred the tax on the payments you haven't received yet. Any gain you already got paid on, well, that tax is done.
So you really have to vet your buyer carefully if you go this route.
Rigorously, absolutely.
Okay, let's use our $1 million park sale example again. Let's say the buyer puts down $200,000 cash, and we, the seller, carry the remaining $800,000. Maybe at 6% interest only for 7 years, then a balloon payment. What does that look like for us?
Okay, in that scenario, you'd receive $48,000 a year in just interest income. Pretty nice cash flow. And the critical part for taxes is you only pay capital gains tax on the portion of any principal payments received that represents your gain. So that $140,000 total tax bill we calculated, it gets spread into much smaller, more manageable chunks each year you receive principal.
So it's tax deferral plus cash flow.
Precisely. Predictable income, often at a decent interest rate, while smoothing out the tax impact.
Okay, now let's talk about the alternative. Maybe the most powerful deferral tool, you hear about it all the time in real estate, the 1031 exchange.
Ah, yes. Section 131 of the Internal Revenue Code.
This is where the seller can defer not just the capital gains tax, but also that depreciation recapture tax, potentially entirely, by immediately rolling the entire profit into a new like-kind investment property.
Right. The fundamental idea here is capital preservation. You're essentially just trading one investment property for another, keeping your money working, and kicking that tax can down the road until you finally do a taxable sale, maybe many years later.
Or never, potentially. People talk about swapping till you drop.
That's the phrase. Because if you hold the exchange property until you pass away, your heirs generally get what's called a step-up in basis to the fair market value at that time, which means, poof, those deferred taxes can disappear entirely.
Wow.
But, and this is a huge but the incredible benefit, comes with absolutely rigid ironclad requirements. There is zero margin for error.
Okay, like what?
First, you can't touch the money yourself. The proceeds from your sale must go directly to a qualified intermediary, or QI. They hold the funds.
Right, the middleman.
And the timeline is brutal and non-negotiable. From the day you close the sale of your old property, you have just 45 days to formally identify in writing potential replacement properties.
Only 45 days. That sounds incredibly tight, especially for finding another mobile home park or similar asset.
It is extremely tight. And then you have a total of 180 days, counting from that original closing date, to successfully close on the purchase of one or more of those identified properties.
You have to stress that, right? Missing those deadlines.
It's catastrophic for the tax deferral. It's not like filing your taxes late where you pay a penalty. If you identify on day 46 or close on day 181, the entire exchange fails. Your full capital gains and recapture tax bill becomes immediately due.
So getting an experienced QI involved early is absolutely essential, just as crucial as a good tax advisor.
Absolutely non-negotiable. You need professionals who live and breathe 1031s.
Now, for mobile home park sellers specifically, What does that new like-kind investment typically look like? Does it have to be another MHP?
No, that's a common misconception. Like kind refers to the nature of the investment held for investment or productive use in a trade or business. It doesn't have to be the exact same type of property.
So what do you see MHP sellers doing?
Well, quite often, we see park sellers trading into assets that are, frankly, less management intensive. Maybe they're tired of the operational headaches.
Makes sense.
So they might exchange into, say, N&N retail properties, triple net lease deals where the tenant pays virtually all the expenses. Property taxes, insurance, maintenance, think Walgreens, Dollar General.
Hands-off invest.
Pretty much. Or maybe self-storage facilities, which are operational but often less intensive than managing tenants in a park. Sometimes it's about climbing the ladder, consolidating several smaller parks into one larger, more efficient one, or just transitioning out of active management altogether as they approach retirement.
Okay, so we've got these two main tools on the table. The installment sale, which gives you cash flow but credit risk,
Right.
and the 1031 exchange, which preserves capital and defers all tax but has those really strict rules and timelines. How does a listener decide which one fits them?
Yeah, it really boils down entirely to your primary goal. Is it maximizing immediate reliable cash flow? Or is it keeping 100% of your principal working and growing tax deferred?
Let's break down that decision tree a bit.
Okay, if your main goal is to generate steady, predictable income, maybe supplement retirement, and you're comfortable with the idea of being a lender, betting the buyer, managing that loan, then the installment sale could be a perfect fit. You get cash flow and the tax hit is spread out. But if your primary goal is to stay invested in real estate, maybe move into something less hands-on, and crucially, preserve every single dollar of your equity to reinvest, then the 1031 exchange is likely your winner. But you absolutely have to be prepared for that intense 45-day identification period and the 180-day closing crunch.
Yeah, it's worth highlighting the complexity again. The installment sale seems flexible on paper, but managing that debt isn't passive.
Not at all.
And the 1031, great for deferral, but that 45-day clock, the pressure must be immense to find the right deal that quickly.
It really is. And that's why some people, especially those who are truly done with real estate investing or just want maximum simplicity for retirement, they just choose to pay the taxes, bite the billet, get full liquidity, sleep well. It's a valid choice.
Simpler, but potentially costly.
Definitely.
Yeah.
But there's also a more sophisticated creative option.
Yeah.
You can sometimes combine them.
How does that work?
Well, you could do a partial 1031 exchange. So you roll over 70% of the proceeds into a new property to defer most of the tax.
Okay.
And then you carry back an installment note for the remaining 30% of the sale price. This way you get significant tax deferral via the 1031, plus immediate cash flow from the note. It can be a neat way to blend capital preservation and income generation.
Interesting. Now, let's circle back quickly to that silent kicker, the depreciation recapture. We know it's a separate tax hit. How do these two strategies handle that specific liability?
Yes, critical point. A properly executed 1031 exchange defers the depreciation recapture tax entirely, along with the capital gains gap.
So it just carries over?
Exactly. That recapture potential, that depreciable basis, it just rolls forward into the new replacement property. So zero tax due today on that recapture amount.
And the installment sale?
The installment sale does not eliminate the recapture liability. It merely spreads it out over the term of the note proportionally as you receive principal payments. So you still pay it, just later and in smaller pieces.
Okay, that's a really important distinction. The 1031 wipes it out for now. The installment sale just delays and spreads it. All right, let's bring it all together with our $1 million sale price example again. We had that $480,000 gain and roughly a $140,000 potential immediate tax bill, including recapture. Let's compare the real-world outcomes for the listener under the three main scenarios.
Okay. Scenario A, the straight cash sale. You sell for $1. You have your $480K gain. You pay the taxes. Let's say it's around $140K to $170K, depending on specifics. You walk away netting roughly maybe $830,000 after tax. You have immediate unrestricted cash. Simple, but you took the full tax hit up front.
Okay. Scenario B, the installment sale. Using our earlier example, $200 stay down, carry $800 at 6% for 7 years. You still have the same total tax burden eventually, but it's spread out, maybe $20K, $25K per year as principal comes in. You're also earning that $48,000 per year in interest. Over the term, you potentially net closer to $950,000 or more, including the interest, plus you had that steady cash flow, but you managed the loan.
Right. Higher total return over time, but with risk and delayed full payout.
And finally, scenario C, the 1031 exchange.
Here, Zero immediate tax. You take the entire $1 million in proceeds, held by the QI, and you reinvest it into a new property within the deadlines. You avoid that 140 to make plus tax hit completely for now. Your full $1 million capital base stays intact and keeps working for you, compounding in the new property. This is the path for maximum long-term capital preservation and growth, assuming you execute it correctly.
The choice seems pretty clear depending on your goals, but also your tolerance for complexity and risk.
Absolutely. So before you even think about accepting an offer on your park, there's a strict checklist you really need to run through.
Okay, give us the action steps.
First, and maybe most importantly, get a CPA or a tax attorney on your team who specifically understands real estate investment sales. Not just someone who does W-2s. They need deep knowledge of basis, recapture, 1031 rules, installment sales.
Find a specialist. Got it.
Second, always ask for a net proceeds worksheet from your advisor before you accept any offer. Don't rely on verbal estimates from a broker. You need to see the projected taxes in black and white based on that specific offer price and terms.
Know the numbers up front. Makes sense.
Third, know your basis cold. Meticulously document every single capital improvement you've ever made. Find those receipts. Every dollar you add to your basis reduces your taxable gain.
Dig through the files. Okay.
Fourth, get crystal clear on your personal goal before you list. Is it immediate cash flow? Is it staying invested but less actively? Is it maximum capital preservation? That core goal dictates which strategy installment sale, 1031, or just paying taxes makes sense for you.
Define the objective first.
And fifth, probably tying it all together.
Yeah.
Do not let anyone, especially a broker who might be feeling deadline pressure, rush you into making this decision without getting that full tax projection and understanding the implications. Rushing here can easily cost you six figures in unnecessary immediate tax liability.
Don't get rushed. Take the time to plan properly.
Exactly.
This whole deep dive really seems to boil down to one core idea, doesn't it? It's not just about the headline sale price. It's about the net proceeds, what you actually keep in your pocket after the tax man has taken his share.
That's the bottom line. Professional planning, done before the sale, means your hard-earned money stays in motion, keeps compounding, maybe earns you interest, instead of just funding the government today. Selling smart means viewing taxes not just as an inevitable obligation, but as a liability that can be legally and strategically managed, deferred, and optimized.
So, the final thought for you, the listener. Before you even think about listing that park, run those numbers. Understand your adjusted basis inside and out. And remember, selling your park might feel like freedom, but selling it smart. That's true financial mastery. Get that specialized tax team in place before the first offer even lands on your desk.